to me, the repo blowout, which occurred last fall, was a huge deal. It indicated that they could not tighten, never tighten, and everyone knows the Fed balance sheet has increased very, very rapidly. In fact, at its most rapid rate in history in the last 6 months, since September, 5 months. And there have been a couple of signals that are very, very important. One that I don't know a lot of people might have seen, but it was in a recent press release or comments by Chairman Powell, where he said that the Fed is considering or has evaluated the concept of keeping interest rates frozen at a low rate like they did post World War II, and letting the size of the Fed balance sheet grow. And to me, that's an enormous clue. They trial balloon these ideas. They float them out there and kind of see what the reaction is. If the reaction is not enormously negative, it's often a clue to where they're going.
SDBullion.com is a high-volume physical gold, silver, and precious metal dealer. At SDBullion.com, you can order your guaranteed physical precious metal bullion products online, 24 hours a day, 7 days a week. Visit SDBullion.com for more information.
Welcome back to the Silver Doctor exclusive. Today, I'm excited to have returning guest, Mr. Lawrence Lepard. He's an investment manager, gold stock fund manager. Today, he's joining us to share his thoughts on the global economy, the political realm, as well as a variety of other subject matter. So, Lawrence, welcome back to Silver Doctors.
Thank you very much. It's an honor to be here with you guys.
Well, I appreciate you taking time to join us on another episode. And so definitely excited to get your thoughts and some of your analysis on where we're at, where we're going, and what's going on currently. And so with that being the case, can you give us a little bit of your thoughts as to what are you keeping an eye on right now, beginning of February, outside of all the things that's going on? What concerns you the most, and what do you keep an eye on at this current moment?
Yeah, that's a great question. So obviously I'm watching the prices of the metals very carefully. And to me, it's interesting. I mean, they've had pretty big run-ups, and generally after big run-ups, you would expect big retracements, but that's not happening, which really is symptomatic in my mind of the fact that we are in a bull market for the metals. A lot of people are thinking, well, I'm going to get a pullback. I'm going to buy that pullback, and they may not get it. They might. No one knows what markets are going to do with certainty, but I'm staying pretty long. I haven't really changed my weightings, and I think the biggest thing that's taking place it's highlighted by a guy named Luke Groman, who's on Twitter, who everybody should follow, is this notion that we're financing the deficits by printing money. To me, the repo blowout, which occurred last fall, was a huge deal. It indicated that they could not tighten, never tighten, and everyone knows the Fed balance sheet has increased very, very rapidly. In fact, at its most rapid rate in history in the last 6 months, since September, 5 months. As a result of that, it's very clear to me that what the government is doing is they are buying their own bonds, and it's been proven and shown. Some people have even traced the QSIP so you can see it. And, they have no way out of this problem. And there have been a couple of signals that are very, very important. One that I don't know a lot of people might have seen, but it was in a recent press release or comments by Chairman Powell, where he said that the Fed is considering or has evaluated the concept of keeping interest rates frozen at a low rate like they did post World War II, and letting the size of the Fed balance sheet grow. And to me, that's an enormous clue. They trial balloon these ideas. They float them out there and kind of see what the reaction is. If the reaction is not enormously negative, it's often a clue to where they're going. And what they need to do, I think everybody can see that we've got too much debt. And so what they need to do, if we had high interest rates, for example, if interest rates went to 5 or 10%, everything would blow up, right? I mean, the government couldn't afford it. People couldn't afford it. It'd just be a mess. So they've got to keep the interest rate low, and they know that. And here's Chairman Powell signaling that he's got a mechanism and a system for doing that, which is to say, post World War II, we had a lot of debt, and it was called financial repression. What they actually did is they said, okay, the 3 month is going to be this, and the 1 year is going to be this, the 2 year is going to be this, and the 10 year is going to be this. And all those numbers, I don't remember them exactly. Luke has them written down, but were quite low, in the kind of 0.5%, 1%, 1.5%, 2% area. And they were well below the rate of inflation, so that anybody who held bonds was getting killed on a real basis. And of course, by holding interest rates artificially low and printing money to do so, you really are creating inflation. So the Fed has given you a big clue that what they intend to do is inflate their way out of this debt problem. And, that's just like, bees to honey for gold and silver. I mean, it's just, if they do that, the balance sheet, as Luke in one of his private letters recently indicated, he thinks the Fed balance sheet is now in the $4 trillion range. He thinks it should go to 10 trillion within a couple of years or larger, right? I mean, that's another doubling of the money supply from where we are today. So this is a big deal.
Yeah.
And it's a clue. And what it says to me is you've got to protect yourself. You've got to get into hard assets. Now, to an extent, stocks might participate as well, because at least they represent a claim on an enterprise that can make money. But bonds are going to be an unmitigated disaster. They may hold together because the Fed will be the ultimate buyer. But I think where this leads to is once it becomes clear that the Fed has to be the ultimate buyer because nobody else wants to buy these bonds and the deficits continue to increase, we're going to ultimately end up with a Weimar-like situation, which I know a lot of people think I'm nuts and that it sounds extreme. But if you read very carefully the history of the period in Germany from 21 to 23, Rudolf von Hammerstein, the guy who was in charge of the central bank in Germany, kind of had the same problem. The debts were huge. They couldn't service them. Interest rates, if they went up, would create a problem. And so he was printing money and buying the debt to keep the interest rates low. It's the same thing here. The big difference is back then, Germany was one country and, Germans could save in dollars or they could save in gold. In fact, I've read a lot of stuff about Weimar. There's a great story of how at one nightclub, some performer was performing. He said, well, everybody here seems very happy tonight. You guys must all hold dollars and pounds, which, indicates that because the dollar, anyone who was smart enough in Germany to see what was going on wasn't holding their savings in the form of the Reichsmark. They were holding it in dollars or pounds or gold. And of course, they protected their savings. And I think that's what's going to happen here in America. I mean, people who are holding bonds, who've got pension obligations to be paid, et cetera, they're not going to get paid. There's actually going on a little further about that. Luke makes a point that I think is just brilliant, which is it's not just the current deficit that's an issue. And the current deficit is $1 trillion and will probably be larger than that. Particularly if you look at the political spectrum, everybody who's running is talking about spending more money. Even Trump is talking about an infrastructure bill. And of course, where's the money for that going to come from? Where's the money for Bernie? If Bernie wins, where's the money for the universal health care going to come from? We all know they're going to print it. But it's not just the $1 trillion deficit, which could become $2 trillion. The related issue is that we've got 200 trillion of obligations to baby boomers who are retiring in the form of Social Security and Medicaid payments, and those are pay as you go. And Luke makes the point. He's right that this is like AIG. AIG had guaranteed all these obligations, but they didn't have the money to back it up. The money's not there. There is no lockbox. So when these obligations, as baby boomers retire and draw on these obligations, the government's going to have to pay them because they're there, or cut them back, which is political suicide. And as they pay them out, that deficit is just going to get bigger and bigger. And eventually, it hasn't even begun to happen yet, but eventually, I think the world and people within the United States are going to realize the U.S. is just hopelessly bankrupt. And when you're hopelessly bankrupt, your currency just can't maintain its value. So I see this happening now. And I think it's a few years out until that recognition point occurs, but really intelligent people who I respect, like a guy named Alistair MacLeod, who writes for Gold Money out of London and is an economist and has been writing for a long time. He actually thinks it could happen this year. He thinks it's so dire and happening so quickly that it could happen by the end of this year. I disagree with that. I think they can hold it together for a while, but it's very clear to me where the trend is in this monetary soup that we're in. And so it's just incredibly favorable for gold and silver investors. And that's why even though we may have pullbacks along the way here, I'm just staying completely invested in the metals and in the mining shares.
Interesting. So yeah, a couple things I want to unpack there. It looks like, when you first mentioned what the possibilities might be for monetary policy coming up. And so that's relatively a new tool out of the toolkit of freezing rates and increasing their balance sheet. And assumably, if they can do that or try to use that toolkit in the next couple years, that'll probably keep things together. But yet, I would imagine they never factored in the health situation that we're facing now, which I believe could speed that process up, especially if China continues to slow down and close up and everything shuts down. And if this event gets worse, like a lot of people say that it might, perhaps they might end up speeding up that process of freezing rates, increasing the balance sheet, on top of them looking to roll out a 20-year treasury note, I believe. And so how does all that factor in? So, like you mentioned, somebody mentioned that it could happen this year. Because of the health scare, could it possibly?
Yeah, it's a great point. First of all, the 20-year bond. Yeah, that's really interesting. If they're thinking of 20 and 30-year bonds, they're thinking of kind of bringing that stuff back because they want to put it out longer. Although interestingly, just as on that point, because the rates at the short end are so low, they're financing about 70% of the deficit right now in the short end, just because it's the cheapest place to get money. But what it also means is they have to roll enormous amounts of money every week, month, quarter, and that's why they've become the biggest bidder through the primary dealers, and they basically sell to the primary dealers because they have to, and then they turn right around and buy it back and increase their balance sheet. But yeah, the health scare is a big deal. I don't know how big a deal. I'm not an expert at all in that area. A guy named Chris Martinson, who's on Twitter as well, is a pathologist, a PhD in pathology he has, and he says he doesn't know how big it is either, and he admits that, but he says he's sure it's bigger than what the Chinese are reporting. And certainly that could factor into it. I think the other thing that could factor into it that's very important to understand is that, the stock market is almost kind of a policy tool. In other words, they've got to keep the stock market up because they know that that's what the confidence is all about, right? And, if the stock market starts to fall and fall significantly, they're going to come in over the top with rate cuts. I mean, it wouldn't surprise me, for example, for them to say, we're going to publicly buy stocks. I mean, most people don't know this, but the Swiss National Bank actually buys public stocks. I mean, it's part of their mandate. The Swiss National Bank owns a huge share of Apple. I mean, I have no idea what the Swiss Central Bank is doing that, but they do it. And it wouldn't surprise me at all if the U.S. Fed went to that point where they said, well, we've got, it's important, it's nationally and critically important that our stock market maintain a certain amount of health, and we're going to put a bin underneath it. Because, if the stock market starts going down, people start feeling poor, they start selling their stocks, the economy slows down. I mean, we all have seen that movie. We saw what happened in 2008. It was focused on housing, but, it could happen again. And honestly, I think the stock market is getting very close. I mean, who knows how far up is too high, but I feel like we're getting close to that point. And the reason I say that is a very interesting data point that I observed this last week or two. Tesla just did kind of a parabola, and whether you like Tesla or not, I mean, I don't even want to argue that because there are pros and cons on both sides. But I like electric cars. I think it's a good idea. Tesla, maybe not so much. But the point is, the stock just behaved like a bottle rocket, and that was the kind of thing that we were seeing in late 2000 or early 2000, late 1999, when the dot-com bubble was about to burst. You had these stocks just going up like bottle rockets. Globe.com, Pets.com. JDS Uniphase, Cisco, they went up parabolically, and then they collapsed. And so it was a signal at that time that, that parabolic run up and belief in these things was a signal that we're very close to the end. And so I see, Tesla is kind of a lead speculative stock. It's a big company, it's the future, some people say, et cetera, et cetera. I can debate that, but the way the price behaved, it went up, peaked, and is now appearing to start to come back down off that peak, reminds me very much of a prior top. And so I would say, I think there's a better than even chance that, the stock market is getting tired, and they're going to have a hard time continuing to keep this thing up. So that's related. The healthcare thing, or the virus thing, I have no idea. I mean, I do know that it can't be good for Apple, right? I mean, they're manufacturing stuff over there and they're selling stuff over there. And it's notable that the Apple stock has lagged. Like Microsoft has done really well in the last 2 weeks. Apple hasn't done nearly as well.
Yeah, and a factor in a lot of companies have shut down and closed down, and stores have closed. So just the economy will come to a stall right now because of this situation over there. And so I've actually saw videos of the city of Wuhan. Looks like a ghost town, like it's a major metropolitan area, and it looks like a ghost town. So people are laying off, and so I'm assuming there's going to be some debt defaults and all types of issues. So the Chinese central bank, or People's Bank of China, will actually have to get in. I'm assuming bail some people out, and so those events just won't be contained within China. And
well, I think that's right. I mean, there's no doubt that if you kind of look at the world and global economy, on a purchasing power basis, China is actually bigger than the United States now, and it's 1.1 billion people. And it's also been the biggest growing economy. It's grown the fastest of all the large economies. And so, if China, so to speak, catches a cold, I mean, the world's going to get the flu. I mean, it's a mess. I mean, it creates a lot of the demand for copper. It creates a lot of demand for a lot of things. And so, there's a real problem. I thought it was very interesting last night, that China kind of blinked and talked about, cutting some of the tariffs they have on some of our goods.
Yeah.
It says to me that they're very aware that they have a serious problem. So yeah, that's another thing that factors into it. Again, I'm not a infectious disease guy, so I have no idea. I mean, this thing could burn out and be no big deal, or it could turn into something really big. I just don't know. I don't think any of us know for sure.
Right.
But it certainly can't be considered a positive, right?
That's very true. Now, have you been following, and did you follow in January? We had the trade deal. And so right. I think midway through January, the phase one was signed. I'm not sure. I haven't read a copy of it yet. Have you had a chance to read a copy of it to see?
No, I did not. I mean, I read the summary of it on Bloomberg, but yeah.
Yeah, so I think that's all we've been getting is a summary of some of the highlights, but not knowing actually what's inside the documentation. And so do you think this health situation and the fact that China's economy is slowing down, and as you mentioned, if China catches a cold, the world gets a flu type of situation, that this phase one deal may not work out. Therefore, it may not be a phase two anytime soon. And, will that impact the markets, and will the stock markets respond to it? Or at this current point, do you think it's kind of built in that there's going to be continue a melt up regardless of what happens news wise?
Yeah. I don't know how to answer that, because I don't think I'm smart enough to know. There are too many moving pieces in there. I kind of tend to, I think, as I mentioned earlier with the Tesla bottle rocket, I tend to actually kind of look more to the technical on some of the stuff. I know that all the markets are overvalued and bubbly and frothy. I don't know when it's going to, I know it will end, and it will end badly. I'm sure of that. I've seen 2 or 3 of these cycles. I don't know when it will end. I don't think anybody really does know when it will end. I thought it was going to end in fourth quarter of 2018. And here we are over a year and change later, and it hasn't ended. And, frankly, I mean, you had a couple, I thought it might have ended a week or two ago. We put in a top, had a pretty severe drop there. But, we're back to new record highs in a couple of the indices, NDX for sure. And I think we made one in S&P yesterday. I don't know what the Dow, we might be close. But the point is that nobody knows when it's going to end. I don't know when it's going to end. But I do know that certain technical patterns repeat themselves, and bottle rockets are a sign that we're close to the end. So, we've got to be getting there. And the fundamentals behind all the trade stuff, I don't really know, just as I don't really know about what will happen with the coronavirus. But again, whether the stock market goes up or down, I'm not really betting on the stock market one way or the other. I think it's a bad bet on the long side, but I certainly am not going to be in there shorting. I think the best way synthetically to play that is to bet on the next asset category that is certain, or in my opinion, very highly likely to do extremely well, as no matter what happens. If even if the market continues going up, I think gold and silver stocks will outperform the market. They did last year. I mean, the market had a good year last year, and yet the stocks and the indices and gold and all that, gold and the gold indices, outperformed. So it's to me, that's a much better bet, because we know that they can't ever stop printing money. We just know that. We saw, they tried, and, you saw the fastest U-turn in Fed history, when they went from, autopilot tightening was what Powell said they were on, to, a complete U-turn, no tightening, QE's on the table, interest rate cuts are possible. We're not going to shrink the balance sheet. We're going to grow the balance sheet. And of course, I find it hysterical the way they're trying to say, this isn't QE, this is temporary. We'll reduce. I mean, that's just blatant propaganda. I mean, there's just no way. I mean, okay, if it's not QE, then just take it away and let's see what happens to interest rates, right?
Right.
But yet, I mean, a lot of people are caught up in this thing, and they really believe, and the market's good and it's going up, and they're geniuses, and Trump's fabulous, and blah blah blah. And so it feeds on itself, and it works until it doesn't. But I feel like we're getting awfully close to the period when it's not going to work. But it could be a year away, 2 years away. I don't know. I mean, it's one thing to keep in mind in these if we're having kind of, in my opinion, a very inflationary, moving towards hyperinflationary melt up, in gold and other things. The Weimar, and Venezuela and Zimbabwe, the stock markets in these countries actually did, in the nominal currency they were denominated, and they actually did well, historically. I mean, stocks go up and can go up, when your currency is getting devalued, because a stock represents a claim on a piece of a business that'll make money in whatever the new currency regime is. So, bonds can go down, but stocks can go up when you're having hyperinflation. So, I don't believe it's going to happen, but I suppose it's a possibility, that we'll have Dow 40 or 50,000 because they're just, and in turn we'll also have 5 or 10% inflation, and we'll also have $3,000 gold. But
now, sorry, watch this. So you say 10, 11% inflation. So as of now, the Jerome Powell, they can't find 2. So will they be outright moving the bar a little bit and then say overshoot?
It's fascinating that you mentioned that, because that's another thing I didn't say earlier. But if you read, I read all the Fed minutes carefully. If you read the Fed minutes, Powell, in one of his comments, said something along the lines of, in the past, inflation has been too low, so maybe we should, for a period of time, let it run a little bit hotter than the 2% that we've targeted. So he's already laying the groundwork for it, right? And by the way, you're smart enough to know, and I know as well, that the 2% is not really what the inflation rate is, right? You go to shadow government statistics, you go to Chapwood, you look at your grocery bill. I mean, we all know inflation is running 5, 6, 7%, maybe higher, and and they do too. But it's their only way out. I mean, they've got to inflate away these debt burdens, or else we get a deflationary collapse. And look, I'm sympathetic to the notion that if they ever stop printing money and they let interest rates go up, and did something like Volcker did in 1980, where he pushed rates to 20%. We would have one hell of a deflationary collapse. The dollar would be sound and all that. But I think that of the two choices of that versus, slowly cooking the inflation rate up, there's absolutely zero doubt, and they've even said it, that they intend to follow the cooking the inflation rate up, because, an outright, deflationary collapse is to them even scarier than inflation. I think that where they're being short-sighted is what they don't realize is that the inflation that they get started, the genie's going to get out of the bottle, and it's not going to be just a little inflation. You can't just have a little inflation and it stays there. It's going to be serious inflation, and then more serious inflation. And when gold takes out, to me the markers are gold's going to take out 1,700. That's going to happen within a month or two. Then gold's going to take out 1,900, which was the high in 2011. So that's going to be very significant when that happens. Everyone's going to say, "Holy shit, gold's at a new high." Then it's going to take out 2,500. People, but people are going to say, "Well, gold's at a new high, but it's going to back off. I'm going to buy it when it dips." It's not going to dip.
Now,
it's going to go to 2,500.
Yeah.
And then people are going to wake up and they're going to go, "Holy crap, this is a real problem here. We're going to 5,000 and 10,000. I mean, the dollar is going to melt, right?" And then the world's going to change.
So at that point, like the actual velocity of money, as of right now, it's all-time lows, and so people seem to be holding on to the Federal Reserve note, i.e., whether it's because it's the best out of all the bad other worse currencies. But so do you anticipate the velocity picking up as a result or within a timely manner of this QE that's underway, or will it be a situation where there will be an overnight occurrence and things will get out of control? Then people will start to look ready to
hard to predict exactly how it unfolds, right? I mean, you don't know if it's going to just happen instantly or slowly. I mean, you could have an overnight reval of the gold price. Markets can be discontinuous. I mean, one of the things people have always kind of assumed is that markets are continuous, that, every day you wake up and it moves a little bit, not a lot. Well, in 29, they weren't continuous. In 87, they weren't continuous. In 08, October 08, they weren't continuous. So it's hard to say whether it's going to go slow or fast. I mean, it's definitely going to trend in the direction of higher gold prices and lower dollar values on a real basis. But I just nobody can predict with certainty how fast, where, and where it happens. That's hard to say. And I think, there's so much ingrained belief in the system. It's going to take, people are going to have to get hit over the head with it, pretty clearly. And to me, I think the hitting over the head part, I mean, look, there's some small friend, people that they call kooks and conspiracy theorists. I got into it with Mike Santoli the other day on Twitter, and he basically called me a kook. And, I love the response of one of the guys that came back and said, well, yeah, nice gaslighting there, Santoli, because I'm not a kook. I mean, this is extremely logical. And, it's going to move beyond the 1 or 5 or 10% of us who understand this today or vaguely understand it into the mainstream. And that takes time. And that's why I don't think it all happens within a year. I think we're 3 to 4 to 5 years away from the real, quote unquote, what I call crisis, where, gold is just roaring, the dollar is just plummeting, inflation is just out of control, and everybody goes, holy crap, this is a real friggin' problem here. And that was occurring, the last time that occurred, it occurred 2 times. Well, the last time it really occurred was from 75 to 79. I I mean, gold in 1975 was $100. In 1979, 80, it was $800. It was an 8-bagger in 5-6 years, right? I mean, if gold does an 8-bagger from here, it'll be at, north of $10,000 an ounce. I mean, at that point in time, you're going to see real fear in people, and people who own bonds are just going to have been decimated. And so, at that point, I mean, whether it's 10,000 an ounce or 100,000 an ounce or infinity, i.e., I don't, my dollars are worth nothing, wheelbarrow money. It doesn't really matter. People are going to kind of know where it ends. And yes, you're right. The velocity is going to go up. Nobody is going to want to hold anything in their dollars. They're going to save, just like the Germans who were at the nightclub who got complimented by the performer. They're going to save their money in terms of something that's sound that they know will not decrease in value. And the 5,000-year solution to that is gold, and the more recent solution to that is Bitcoin. But Bitcoin, a lot of people are scared of Bitcoin, so they won't go there. But I'm not. I think it's a great idea. And so these sound money alternatives are going to be what's going to protect some people who are aware of the problem and kind of got ahead of it. And unfortunately, and rather tragically, a lot of other people are going to get hurt. They're going to get very, very badly hurt. It's very sad. I mean, the only bright side of it all is that, hopefully that sadness and hurt will lead to very, very serious reform in this country, which is deeply needed. I mean, and I could just name a few things. I mean, 1, a gold standard and sound money. 2, term limits. 3, all the money out of politics. I mean, a lot of the things that would make those of us who are just regular citizens realize that we're not living in a kleptocracy, that, where all the people at the top get all the money and make the rules, which is what we are living in right now. And it's frankly, it's why we're all pissed off. And I think rightly so. And unfortunately, we can't change it, very easily by ourselves. But when they're, these people who are running it, they're overconfident. They've got a lot of hubris, and that's going to catch up to them. It's going to blow up in their faces, and they're going to be disgraced. And those of us who are sitting around and know that what should be done are going to stand up and say, okay, this is pretty simple. I mean, after the German collapse in 23, they actually put their economy back on a sound footing very quickly by going to a gold standard. Now, unfortunately, a lot of the people were so hurt, so pissed off, so angry that when a demagogue came along named Hitler, they fell for it. They're like, oh, this guy's going to make Germany great again. Let's go with him. And hopefully, we'll be smart enough not to make that mistake. But the point is, Germany was a mess in 1923. November 1923, the Reichsmark was useless. And within a year or two, on a sound currency, they had recovered. All the debt was wiped out. A lot of the rich people weren't rich anymore. But, the average person doesn't have a ton of debt. Well, that's not true. But a lot of people, they don't have a ton of debt. They don't have a ton of savings. They have their labor. They have their capacity to work. And, plumbers are going to be fine. The currency can go to zero. Plumbers are going to be fine. Shit's still going to need to be fixed. And whatever the new currency is, they're going to get paid in the new currency. The sad part is the people who get hurt are the people who are living on a fixed income, people who have savings, people who save their money in dollars, people who save their money in bonds, and all that stuff's going to become worthless. And it's incredibly tragic. But if they're paying attention and they're thinking about it, they'll take some of those savings, and it doesn't mean all of their savings, it just means a piece, and put them into, silver and gold coins that they hold in control. And those will appreciate enormously. I mean, even as little as a 10% allocation, could more or less save their bacon. But if they have zero, it's going to be, unfortunately, it's not going to be good for them. So that's why I advocate, being in this asset category.
All right. Now, let me get your thoughts on some recent activity over the last couple of weeks. And so Palladium looks like it has done really extremely well. And so I don't follow that metal in particular. So what are your thoughts on that? And why was that? And is that?
I don't follow Palladium either. And I believe the precious metals are manipulated. I don't think there's any doubt about that. I mean, there's just recently a case where criminal charges are being filed against J.P. Morgan for manipulating gold and silver. I think that's an early indicator of, problems in some of these markets. And, I don't know the Palladium market, so I can't really comment much on it. But smart people I know and follow say that this is like a warning sign, and that what's happening in Palladium might someday happen in silver and gold. There is very little, if perhaps no, paper market in Palladium, and so when it gets short, the price can skyrocket. And there's a big paper market in silver and gold. One thing I say here is people who want to fight the system and want to accelerate, the demise of, the kind of the money lenders and all the people who've got control of this, corrupt system. I think the best thing everyone can do is actually take physical delivery of gold and silver coins, because there are tons and tons of paper claims against a very small number of actual physical ounces. And, people who buy GLD or SLV, they're buying a paper claim on gold that may not be fulfilled. I mean, for all we know, they're Lehman Brothers, right? They'll fail and do a force majeure, and you won't get the benefit of the gold or silver you thought you bought. So, one of the things I've taken to doing on some of my Twitter posts is putting, #take delivery. Gold isn't yours. You think you own gold if you own an ETF that says it owns gold, but you don't. You really only own gold if you have the coins yourself, or if you store them in a safe deposit box, or, a safe place to put them. I mean, a good solution that I use actually is something in Switzerland called Bullion Vault. www.bullionvault is I believe a legitimate, I've done the due diligence, safe alternative to actually owning the coins and putting them in your basement, which somewhat opens you up to the risk that somebody knows you have them and can come and try and take them from you. But to me, yeah, what's happening in palladium will probably happen in silver and gold someday as this gets further along. So.
Interesting. Well, Mr. Lawrence Lepard, it's been great having you join us here on Silver Doctors. And so looking forward to continue to follow your work and keep an eye on what you have going on via your Twitter account. And so for those that are interested in continuing to stay in tune with what you have going on, point them back to where you're at and definitely.
Yeah, let me give you 2 pieces of information. Thank you very much for having me. First of all, I really appreciate the venue. Second of all, you can follow me on Twitter at Lawrence Lepard. And then I also do a quarterly newsletter where I talk about all these issues. I'm happy to add anybody to it. It's free. So it's at my email address, which is Lepard, so 2 L's, EPARD, at EMA2.com. So that's Edward Mark Alpha, 2.com. Anyone who sends me an email, I'll add you to that list, and you'll get my email letter, which comes out. I come out every quarter for sure, and sometimes I come out with interim things. So it'll just kind of keep you appraised of what I'm thinking. But thank you again for having me on. It's always a pleasure. You clearly understand what's going on here, and I think the service you're providing is a great service.
I appreciate that. Thank you. Well, thank you for taking time. Thanks for joining. Thanks for those compliments there. Looking forward to have you back on in a couple months as things really begin to unwind, and we'll see where we're at that point.
It's always interesting. I'll tell you, it's going to be a hell of a ride.
Yes, it will. So once again, Lawrence, thanks for joining us. Looking forward to have you back on in the near future. Thanks.
Great. Thank you. Bye-bye.